Good morning, traders and investors around the world. Welcome to this Friday, May 20th expiration edition of pre-market prep with StockOdds. Joel Elconin joined by Rob Friesen here on a choppy session here. S&P 500 futures eroding much of those early morning gains, now up only 11 and a half handles at 39.09. Haven't seen that pre-market low yet, but we keep falling like this, we will soon. Crude, the rollover to the July contract, up 34 cents, 110.23. Gold giving back some of those gains from earlier in the week, down 670, 18.34 and a half. Silver in the red by 16 cents, 21.75. Bitcoin just under 30K, down $35, 29,910. The 30-year futures, they're going the other way. They're up $19 at 20,012. So we all know what the third Friday of the month is, and the third Friday of the month is options expiration. And on options expiration, certain things go on a little bit different in the markets. Rob, why don't you explain the one thing that you need to know about option expiration? How's that for an introduction?
Yeah,
Man, I'm good. I want a raise.
No, but the problem is you always want a slogan or some kind of catchy word or something, for the show, right? So I just whatever the first thing that pops into my head is what I give you. So
it's good, Rob. It's good. You're like who needs Kramer? I got Rob Friesen.
It's just like, oh, I got to tell Joel something. Oh, okay. Well, one thing about expiration. Okay, well, what is
That's
that
good,
one
though.
thing?
I like it, and I get all excited about it. So let's go. What do I need to know about expiration?
Well, generally speaking, this has been my observation for about 30 years now. Yes, I've been around, started with penny stocks back in 1992, so I've been around for a while. My observation is that the print that you get at the open on expiration morning is specifically related to expiration, meaning that you got to look at the buy imbalances or sell imbalances and how the market's opening. And that can often be the high or the low of the day, depending on how we go. So it would work like this. You come in the morning and you see a lot of stocks wanting to gap up. You got buy imbalances if you can see them on your platform. And so that order imbalance is partially due to the expiration event, right? Not completely, but in many cases it is. And so once that goes through, it's like business is done. Let's let's go hit the ski slopes. Let's go hit the beach. It's done. And
hey, Rob, I'm going to interrupt you here for a second. I mean, a lot of the options are based on the close too, though. What are you specifically?
Well, a lot of the adjustments are done on the morning of expiration, not just on the close, okay. Right? Okay. So my point is those imbalances are often related to that. Not exclusively. There's one thing that I wanted to point out, though, and that is not to be surprised by this. So let me share my screen.
Okay.
I mean, it's not something that we can write and say this is 100% guaranteed. It's no different than other probabilities like the turn of the month effect and things like that we've talked about. But if you can see my screen, you can see that the SPY was definitely at a premium, kind of coming in a little bit from the overnight highs. We opened and then we've pulled back since. So let's look at, this is the problem with people trading, especially baskets and stuff. We're trying to fill in that context as you approach. So this is just the S&P 500, a snapshot here of some of them. And I could go through, dozens and dozens of them. And you see the same thing. You see positive gap up, and then it's pulled back from the open, right? And that's sort of across the board. Many stocks gapped this morning and they've pulled in. That is something that I see and I'm prepared for on expiration mornings over and over and over again. If it gaps down, that could be the low print of the day. If it gaps up, it could be the high print of the day. So what you're looking for is buy imbalances and a gap up.
Shoot, Rob, I that was my bad. I did that, Rob.
Oh, okay.
I meant to mute myself for a second.
Oh, okay. Did you catch that? So it's buy imbalances with the stocks gapping up, because you could have a buy imbalance and it's not gapping up. So it's that combination of buy imbalances, stocks are gapping up, open at a premium, and then you get the gap fill on many stocks. Same thing on other way. If we were gapping down, you would want to see sell imbalances. Once that's flushed through, we move back and retrace. So this gap fill situation is one of the things that you look for on expiration mornings.
You know what today was? Today was gap and crap.
Well, yeah, not gap and go. So a very different day than what we had when we had the reversal, and we saw an indication in the last hour of the Thursday that there was risk on. Carried through to the Friday, we had the gap and go, and this is expiration Friday. So that's what I wanted to point out, and that is not just one sample observation. This what's just happened today, I have seen so many times. Okay, and it's that combination of order imbalances and direction of the market gap, and it often gets filled. So what you're seeing here is, and they're not even big gaps, 1%, 2%, but look at the damage right afterwards, and then some of that's related to concerns for the weekend. We've talked about that before. Some of it's related to, hey, this is a chance to, I always tell people, if somebody ever said, hey, I need to, get out of something, liquidate it or whatever, I'm going to, I want to sell out. It's like, you kind of want to wait for an up day to do that. You don't want to, when you're down 1,000 points near the end of the day, it's not a great day to liquidate everything. Would you agree? You're mute.
I did mute myself here. Yeah, it all depends. You have to, know when to cut your losses, right? That's another thing. So like at the end of the day, when I talk about this on the show, if you're getting the crap kicked out of you and something on the day trade, chances are if you take it home with you, it's it's not going to be much better in the morning. But
there's that element to it too. But like at
I
the
agree
same time,
with you.
You've been an office manager before, and somebody's had a problem. A lot of times an orderly unwind instead of just like close your eyes and market out of it. So you try to trade out of it incrementally, and that can often be a better approach than just emotionally reacting to something and getting out, right?
Eric said he got his hedges on. Okay, they're costing me money, but that's what an insurance policy is supposed to do. Overall,
well, the beautiful thing about the hedges. Let's just flip it to, here's all the ETFs here. They have the same thing, right? Is that they gapped up and they've pulled back. So if you're using ETF hedges, they're pulling back. They're not pulling back as much because they're statistically muted because they contain all the other stocks. So the stocks themselves, the ones that gap the most be pulling back the most. The ones that have higher volatility might be really moving a lot. So you're not completely insulated, but it's sure helpful. And the other thing though is, like, if you went to buy the SDS, which is the inverse to go long, that opened at a discount because the SPY was gapping up, right? So our gap on the SPY was 0.91%, and it's pulled back, 0.73, so almost a full amount. It's actually bounced, so it did literally completely fill that gap. And again, your SDS, if we put that in our list here, you'll see that it opened down. SDS. There's SDS. It opened, gap down 1.99%. And so if you're using that for coverage, let's say you've got a bunch of long stocks that you're needing to buy. Again, I recommend understanding why this day might be different than other days because it's expiration. So that's a good thing, a good helpful thing. So if in that sense you could go, you know what? I'm going to take a nibble on SDS and I'm going to have my stock standing by to see if I can get the gap fill after the opening print. And I'm going to put my basket on, piece by piece as I'm getting the pullbacks on the stocks. That's a valid approach. You don't have to, just because you've curated stuff to go from the open to close doesn't mean that you have to. Nobody has a gun to your head that says you got to put it on. If the conditions aren't right where you'd have to be paying too much for those stocks you want, then put them in the watch list and wait. But you can nibble on some stuff so that you get informed. Actually being in small trades is much more valuable than watching the movie go by, right? So anyway, the other thing I want to point out is that you can go to, I have to stop share because I don't have permission to share this because it's somebody's research, but you can look it up for yourself. It's yardini.com, right?
Ed Yardini?
Yeah.
I know Ed.
So anyway, they've done a tremendous amount of research on, there's a PDF you can download. It's called Stock Market PE ratio stuff. You can download it and look at it all. So I can describe it. Over the long sample, when we have 20, this is the amount of stocks in the S&P 500 that are above a 20 PE multiple, right? There's 38.2% of them right now that are above 20. So those are starting to roll over, and the percentage of those stocks is decreasing. And the percentage of the stocks that are below 10 PE is 16.5. So imagine it like this. That percentage of those stocks that are really high P multiples is rolling over. The ones that are really low are starting to climb. So what does that mean? That means that this constant transfer, which we saw start, was the second trading day of January of this year. We just saw an aggressive approach, and we did mention it on the show, an aggressive approach to selling the things with high PE multiples and buying the things with low PE multiples, low volatility, that sort of thing. That's continuing. But here's what I want to point out, that in every other occasion throughout the years, they've reverted to almost better, more even distribution of 30% are over 20 and 30% are below 10. And so we've got a ways to go for that to happen. And I would recommend you look at all their research on PEs and that mean reverting tendency of the market, because, we don't have money falling out of helicopters anymore. And so the appetite for speculation, the appetite for risk is reduced. And institutions still have to do things. So what are they doing? They're repositioning in some of the better value propositions. You want dividends if you can, you want earnings, and you don't want to pay too much for them. So there's, those that have a disciplined approach to trade, to investing, are going to, reallocate and things like that. So that's still in process. We're not finished with it yet, even though some people have called for, the bottom's in and this and that. We really don't know, but what we can do is tap into these trends. Another things you can do is kind of look at your value versus growth ETFs, look at your small cap versus mega cap, like just really dial in and pay attention to how money's moving, right? And so it looks like it took maybe about a year to a year and a half historically for these two PEs to the really over over 20 multiples and the ones below 20 for them to come closer together. Takes time. It doesn't happen just like this.
No, it takes time to move money around. Rob, I wanted to get your comments. Are you finished with that? Because I wanted to get your comment.
Yeah, go ahead. I just recommend going to the website and looking for yourself. There's hundreds of slides there that you can look at. Okay.
What about the utilities?
Well, utilities are sensitive to interest rates because they have such a large bond component, right?
Yep.
So they don't trade in a vacuum. They trade related.
But they've just been holding up incredibly well. Do you think that they came after the value? They came after the Procter and Gamble. They came after the McDonald's. I mean, is that the next shoe to fall in this market?
Well, it is. I would say utilities have become more crowded, and I can probably. I think their PEs are getting more elevated with the transfer of capital into utilities, because it is, it's like in crypto. If there's concerns, people move to USDC, the stable coin, run by Coinbase there. In the market, you move to money market funds, you move to treasuries, you move to the defensive sectors, and utilities are certainly one of them. If any of the groups kind of trade at a bit of odds with the S&P, it would be the utilities. Like the correlation would be the lower side of things, right? That's why I love these type of days where you have a huge risk on day. You can just see the appetite for risk is there. Everybody wants something, and the utilities are actually gapping up with that. I love that because then you can short the utilities at a premium, and with the expectation that they're going to give it up because it's a risk on day. So they're going to take some profit on the defensive things. Does that make sense?
Yeah, it sure does. Okay. All right. We just came down. We're near the pre-market low here, 98.25. We just hit 99.25. So giving back all the gains, not good here on this Friday expiration. Really, main number below this pre-market low. You have the close at 97.75, folks. But what we got to keep our eye on today, and not only today, but moving forward. Last Thursday's low, 38.55. Your low in the pre-market session yesterday, 38.56. So
I wish I would have counted, the number of monthly expirations and quarterly expirations over all those years to give you an exact count of, and you could certainly go back and run the research for yourself too. But how many times the opening print was either the high of the day?
Oh, I know. I agree.
Day, right?
Yep. Okay. All right, Rob. Well, have a good weekend. I'm going with simplification in the Preakness out of the one hole, a little bit of a long shot. So if you want my pick there for the Preakness, everyone, thanks for joining me. And
you can be an advisor on the horses, eh?
Yes. That's not investment or gambling advice. Thank you guys, and we'll see you guys on Monday.
All right. Have a good weekend.